Manish, first of all, welcome to Power Talks. Thank you so much for taking out the time. And I'll get to right to the chase on the Bandhan Small Cap Fund, right? It's a rock star performer in the top three, for the last couple of years. What's your secret recipe?
First of all, thanks for having me. Thanks for the kind introduction. Um, so when we look at our small cap fund, there are a few things which we feel are driving that performance, and hopefully that should help it sustain. So first of all, a lot of it is team effort, right? I mean, there are fund managers, Kirti and I, but honestly, if you see the portfolio, the most frequently asked question we get is why does it have so many stocks?
Yes,
Right?
absolutely.
Uh, so part of it is because there is a big contribution of the research team. And we have a lot of analysts, they cover a lot of stocks. We get a lot of ideas every day when we talk to them. And we feel we should have all those ideas because people are passionate about those ideas, right? But it's also hopefully a well thought out risk management here, right? There are different types of risks we run with small cap fund, right? The first is that the companies here are genuinely a bit more fragile than the large cap companies. So if a big client leaves, if a CEO leaves, if some regulation changes, they do get affected fundamentally more than a HDFC Bank or Infosys would, right? So the point here is that we don't bet too much on one single company. So if you see our top weight would probably be this 3 to 4%, not more than that. So that's the first, that we are trying to diversify fundamental risk. The second is we are also trying to diversify liquidity risk, right? Because as the fund scales up, so when the brand change to Bandhan happened, this used to be a 1,300 crore fund. Today we are almost 18,000 crores. So as it scales, we are conscious that if 2 years back I was owning 1% in a one particular stock, and today I own 1%, but the absolute amount of money I put in that 1% is a lot more, right?
Yeah.
So my position is a bit more tougher to sell today than 2 years back, which is why also we run this granular portfolio of more than 200 stocks, because it helps us manage liquidity. And if you see the SEBI mandates you to disclose some liquidity parameters, and we've been fairly top notch on those parameters. That's the second risk. The third is macro risk, in the sense that if you consider it too much in a sector or style, these sector or styles typically work in a particular environment. Like, I'll give you an example. 2017 to 19, globally interest rates were very, very low. Fed was at zero. And if you remember, that was a time when high quality stocks, FMCG, private banks, they were the leaders of the market, because valuation was not so much of a concern with people, because the earning growth was not there across most of the sectors, all these commodity cyclical sectors. There was no earning growth. So basically the market got cornered into a very narrow band with only specific sectors working. But post-COVID, when inflation came back, nominal GDP growth came back from the very weak base of COVID, all the cyclical stocks, your commodities, etc., worked, right? Now, here the point is, it's very tough to call what regime works in a market, right? So in 2019, if you had told that commodities will be hot 2 years later, people would have been very, very surprised. So the point here is, we are not betting a lot on a sector or style per se. So we try to confine our bet on a particular sector or style to a certain level. We don't go overboard. Like, for example, in small cap index, if lending financials are, let's say, 15%, in the small cap fund, we might be 10, we might be 25, but it's not like we'll be 0 or 50. We are not betting the house on one single sector. So when you need to have different sectors, number of stocks will obviously go up. So the simple point here is, whether it's liquidity risk, fundamental risk, macro risk, we try to manage those risks in a very hopefully well thought out manner. So our initial thesis when we build this framework was not to outperform in 1 or 2 years. We felt that if we are quartile 1 or quartile 2 every calendar year for 4 or 5 years in a row, then you become top decile or, 1 out of 50 fund or whatever. That's what it's just been lucky, or we got some themes right, but the portfolio hopefully is a very resilient portfolio. I think across different macro scenarios, if Fed is at 5, Fed is at 0, hopefully we will not get knocked out by anything. And, the last 3-year performance, as I said, has surprised us. In spite of such a granular portfolio, we've been fairly top of the charts. But as I said, going forward, what we keep telling investors is that we don't want to be top decile in 3 months or 6 months. It's just that every year we just want to be top quartile, beat the benchmark by a decent margin. And we hope that builds the long-term track record.
Right. No, great. And I think that sets a lot of context for, the background of, the small cap, Bandhan small cap journey. You spoke about 3 factors, right? Fundamental risk, liquidity, and the macro, how you're in line. And I have actually questions on all 3 of them. But first, in terms of the granular portfolio, right? Over 200 stocks. And I think more than 100 stocks are outside the Nifty 500 universe.
Yeah.
So first, I want to understand, like, how big is the team that they're able to manage, and sort of give due diligence to each of those stocks? I think you cover more than 700 stocks, right? So how big is this team, and how do you manage that each stock is, taken care of?
So we have about 15 investment professionals. There are 3 or 4 of them who don't do research. Rest all do research. So this 700 odd stocks is done by a team of 10, 11 analysts. But more than the size of the team, which itself is quite respectable. Obviously, it's a reasonably large team. But I think it's also a bit of focus. I think it's culture about being passionate about stock picking, which people are incentivized to go down the market cap curve and pick that 2,000 or 5,000 crore market cap company. I've seen what tends to happen in many AMCs is because the amount of money you deploy is mostly in large caps. Like, let's say you're managing 2 lakh crores, right? Typically, if you see, the AMC would have about 50 to 70% in large caps, about 10 to 30% mid cap, only last 10 to 15% in small caps. So what I've seen is the process design in a lot of AMCs is the importance given to a stock is proportional to how much money you deploy. We don't see it necessarily that way because we feel that if a smaller stock can be, let's say, 5x in 3 years, it's worth spending effort on it. You may be able to deploy initially only 25 crores or 50 crores, but the kind of impact it creates on the portfolio is so immense. So we have some processes where we incentivize analysts just to look at the small cap universe. So I think team, you need to invest a lot. But it's also a bit about process and culture, how you orient the team towards stock picking.
Got it. And since you mentioned stock picking, I was, in fact, I think reading one of your interviews, you mentioned about picking stocks that double every 3-4 years, right? And that's the key sort of strategy, at least in the small cap universe. Is that the same framework you also use in large and mid? Because you're large and...
No. So that's the fun part about doing small caps is... see, by nature, I think very passionate investors are absolute return oriented, right? But most benchmark oriented funds, large, flexi cap, large mid, you need to be a bit benchmark centric because you're deploying largely most of the money in large and mid cap stocks, which are like 3 billion, 4 billion market caps. And obviously the price discovery is more efficient there. So it's unlikely that you will have an insight which is so different that you can create enormous amount of alpha on one particular stock. The real juice is probably in the small cap because the pricing discovery is not so efficient, right? A lot of people are not researching it properly. the amount of information that is available on these companies is not as much as for the large companies.
Right.
So the way we manage the small cap fund, just to continue our earlier discussion, is also that while in large or flexi cap, we are a bit more benchmark centric. You're correct that we kind of look at small cap in a more absolute sense. And the logic for saying that try to be in stocks or at least start buying stocks when you feel that they will double in 3 to 4 years is as follows. So kind of quantitative logic here, right? So simply put, if a stock doubles in 3 to 4 years, that's typically 18 to 24% compounding annual return, right? If the stock does 18 to 24% average annual return, then the stock will double in 3 to 4 years. Now, when we look at the market from a very long-term view, we do think today, for example, you're starting at a fair value point. It might be 5% overvalued, 5% undervalued. There's nothing great. It's not distress valuation. It's not bubble valuation. So when you are around fair value, what's generally been seen across markets is, if I take a 10-year view, you should expect large cap to do same as nominal GDP, which is 10-11%. We think mid cap index will also do 10-11%. Now, if I do 18 to 24 aspirational, remember this is aspiration, our hit rate will not be 100%. But let's assume that 6 or 7 out of 10 stocks we buy, we hit what we want, 3 or 4 will fail. So on a blended basis, we should do 15 to 20% for the portfolio. It will be less than the 18 to 24%. But still, we think it will be materially higher than what the large cap index or mid cap index will do. We don't know about what small cap index will do because small cap index tends to be very, very fragmented, 400 stocks or something. So we rather focus on this absolute thought process.
Got it.
That even if we fail in 30-40% of the stocks,
that's also a good
that's also a good place to be. And our dream, by the way, this fund is kind of modeled on this legendary investor Peter Lynch.
Okay.
So he ran this Magellan fund from 1977-78 to 1990. And in US, which is a very mature market, right? He still produced 30% CAGR for 12-13 years. And he ended up with 1,400 stocks in the portfolio.
1,400?
Yeah.
Wow. So are we to
So whenever people ask us about 200,
it's still
I had to quote
scratching the
about Magellan fund.
Very, very interesting. But also I think I was reading on, around that you don't believe in the buy and hold strategy, and a lot of churn also happens in these fund houses. So what's your strategy for both buying and selling, right? Because buying, I understand that's your target to double it every 3-4 years.
Yeah.
And at the same time, you're also very active on the sell side as well. So that, you can deliver those returns. So what is like the investment philosophy and the strategy behind it?
So we sell based on different things. One is, of course, the best reason we sell is because the stock has done what we wanted. That obviously. But we're careful to say that just because we own this stock, it has done well. We try to be very objective and not get emotionally attached to it. So sometimes the mistake that happens is you get very emotionally engaged with the management of a company which has done well. And you buy and hold when the valuation doesn't give you any great return. We've seen very good companies, whether it's Bajaj Finance or Astral Pipes. They've been very well managed companies. They've delivered good earnings growth. But if you bought them at a wrong valuation, we've seen that you will not make money for 3-5 years. So we're very conscious that just because a stock has done well for us doesn't mean we need to own it all the time. So that's the first point. The second is genuinely we go wrong on business model, regulation, and management, right? I mean, as I said, out of 10 stocks you buy. And I think, again, we try to be objective, saying that we had an initial thesis, whether it's changed because of macro, because of regulation, because our perception of management is not as positive as it was. Then we try to cut our losses and sell. The third reason we would sell is if we see a big macro change globally or in India. So let me give you an example again, that a lot of people have been feeling that US will go into a recession, right? Which has not happened. But let's say we own a IT services stock where most of the revenue comes from US. And let's say suddenly if the US 10-year yield falls 50 bips in, let's say, 2 months. Well, that's typically a indicator that a slowdown is coming, because why would 10-year yields fall? And then we will, as you said, we are high churn in that sense that we will not wait and disregard this piece of information. So if we have stocks whose exposure is to US, then we would worry about it. How much we'll sell is another thing, but we will act on it if we feel that a big macro change is happening.
Got it. Got it. So I think this helps me understand, how you cater to the fundamental risk in terms of stock picking and selling. The second thing you mentioned is the liquidity risk, right? And I think having a large long tail of stocks helps. Also, I saw that you were sitting on high cash also.
Yeah.
So is that you're finding the right opportunity to invest? Do the valuations seem high? Like, what is your...
Yeah. So as per fact sheet data, you'll see that we've been sitting for last 3-4 months at least on 11 to 12% plus cash. See, our usual cash level is around 5 to 7%. So you could say we are about 5-7% excessive cash. It's not so much of a valuation call, honestly. This is a bit of maybe a gut feel, but basically we feel that post the bounce back in small cap in 2023 to 25 beginning, and then we've seen 12 months of almost zero return. See what happens when a bull market starts. It takes time for new issues or promoters or private equity funds to start selling. So typically in the second, third year that comes. And which is what we're seeing for the last 3-4 months, that we've seen a lot of big IPOs, a lot of big blocks by private equity sellers, etc. And in a way, we're kind of trying to time this because we feel next 3 to 4 months, the market is not going to go anywhere, not because of earnings or valuations or anything fundamental. It's just that we have this bunched up supply, which has been waiting for last 2 years, which will come through now.
Okay.
And we feel that this 5-7%, which we have excess cash, we will keep getting opportunities as the market consolidates. You will also see some panic selling by retail or HNIs, I think, because this is very similar to what happened, if you remember, from October 21 to March 23, right? Because Fed hiked rates more than people thought. Globally, we had a very soft equity market. We didn't see too much of drawdown, but we saw time-wise correction for about 18 months. And if you see, I think the last phase from Jan to March of 2023, the domestic flow started coming down. So from 40-45,000 crores per month of inflow into mutual fund, we saw somewhere around 30,000. The retail started panicking a bit, saying for 18 months no return.
That's always...
Which is when the small cap bottom was made. So we're kind of anticipating that last phase in the next 3 to 6 months.
Okay.
Where we see the market may just consolidate, fall 3-5% here or there. A lot of small caps will fall 15-20% more. I think a lot of small caps already are at attractive valuation levels, but we still think there might be one last leg down purely because it will tire out people a bit.
Like setting the right sort of expectations,
Yeah.
anchoring them. But you feel like in the short term, you feel like there might be one more correction. But what's your...
I would say more consolidation. It could be -5 +2, but it'll tire out people, I think, next 3-6 months.
Got it.
It's a gut feel.
Yeah.
I've been
But I
very bad in short-term market calls.
No, but I think gut feel from someone who has delivered 40-50% returns, I think it's worth taking.
But also we generally feel, boss, ki 88% what you own, if it does well, the last 5% is not going to matter that much, right? So it's okay.
Yeah. But then overall, for the next 2-3 years, right? Do you see the markets bouncing back? Because last 1 year has been quite flat.
Should be ready for very sober returns. As I said, we are at fair value zone. So I think 10-11% on the indices. Small cap index, I don't really talk about because I have said this a lot of times that small cap is not an asset class actually, in the sense that out of the 600, 700 potential stocks, it's the 100 or 150 own that's going to create a difference. So the index may go anywhere, but if you get those 100, 150 stocks right, then your returns can be very different from the index, which is unlikely in large and mid because the number of stocks itself is so limited. So, so I don't talk about small cap index, what it will do on a 3-year basis, but I do think large and mid cap index likely to do somewhere around that nominal GDP number. Small cap be very aspirational that we will touch Peter Lynch kind of returns, but let's see.
Let's see, or fingers crossed.
Yeah.
No, I think that makes a lot of sense, Manish. And going to the third part of your thesis, which is in line with the macro allocations, right? As I told you, right, I am an investor in Bandhan Small Caps. I was reading through the fact sheet, and I saw that you were quite over-indexed on 2 sectors: financials and real estate.
Yeah.
So what about them? Like, why are you so bullish on them? Those.
So as I said, small cap, we are fairly bottom up. So first of all, these sectors are cheap, right? If you see real estate stocks haven't done much for last 2-3 years. Financials also, while they've bounced back this calendar year a bit, but when you see a lot of stocks are below book, credit growth's not been very high. So the macro thinking here, to whatever extent we think about, is this, that India is one of the few countries where you have ample source for stimulating the economy. So see, if you see Japan, for example, right, with inflation of 3%, the 10-year yield is 1.7%, right? So you're already running negative real rates. Unlikely you can cut interest rates. The debt to GDP, the government debt to GDP is 250% or whatever. So they can't even, I mean, they're still doing fiscal stimulus, but you can't do it at big scale, right? When you have those kind of constraints. Now you think about India, that our inflation is less than Japan, but our 10-year yield is 6.5, more or less. So we have very high real rates, right? Our WPI is virtually zero. Our CPI is 1.5%. So you have very high interest rates versus inflation. You have, when you go to the fiscal accounts, our debt to GDP is about 80% odd. So there's a lot of leeway in terms of raising debt to GDP, although government wants to get it down. But in case you see a slowdown, there is a fair amount of ammunition. Our fiscal levels are a bit high, but I think because our nominal GDP growth is healthy, our debt to GDP is not increasing, unlike mature economies like US or Japan, etc. So our simple point is, when you have an economy where the monetary and fiscal stimulus can still be applied, which happened through GST cuts, which has happened through tax cuts, there is more upside to the economic growth than downside. Because in case there are further signs of a slowdown, you still have a lot of space to cut rates or increase government spending. In which case, it makes sense to be in cyclicals on the domestic side rather than look at very defensive companies or look at global companies too much. Having said that, I should also tell you that the third largest overweight is textiles, which is very different, right? Caters to US.
Export.
But again, as I said, for us, valuation is the first big important thing. But yes, the top 2 overweights align with this macro thought as well, that the biggest buffer today in terms of in case things go wrong, where the government can act very quickly either through interest rates or government spending, is on the domestic side. So, and these 2 cyclicals are fairly cheap.
So financial service, I understand because of this angle. What about real estate? Like, is it because of the consumption story? Like, What's your
Yeah,
one?
so there are multiple threads there. One is it's obviously a macro cyclical that if a country's economic growth picks up, real estate tends to do well. But there's further thing there that we also feel that if you see the supply side, it's one of the few sectors left in India where unorganized is very big. So unorganized, I don't mean by someone who's not paying GST or anything of the sort, but if you see the quality of builders who are, let's say, who can do, let's say, 1,000 crore project and above. It's very limited. So in each city, there are probably 4 or 5 developers who can bid for a land parcel where you can do 1,000 crores, 2,000 crore turnover. And we feel that these developers, what typically tend to be the large listed ones, they will keep getting market share because still the sector is 70-80% with the builders who are doing, 20 crore project or a 50 crore project or a 100 crore project. Because the customer preference is changing, right? Because in India, infrastructure is a bit weak. If you can afford it, you tend to want to stay in a gated community which has a gym and a clubhouse or a swimming pool or whatever. And we think as India becomes prosperous, more and more people will want that, which means bigger projects, which means the market share of the large and listed developers keeps going up. Also, there's been regulatory push for this. The biggest being RERA that your ability to get capital is now confined to the bigger developers, because the smaller developers, they can't move money from one project to another because of RERA, right?
Yeah.
So we do think that this one of those few large sectors left. I think this and retailing are the last two sectors where this unorganized to organized or the consolidation. Like we've seen in banking that the bigger banks have become bigger over time, and top 4 or 5 banks are probably 60-70% of the industry. We've seen telecom. So there are various sectors where we've seen the top 5 players become big part of the industry. Um, while real estate will never be that consolidated, globally it's never as consolidated as telecom or banking. But I do think that from the very fragmented nature we have today, this sector will consolidate it, which means that the bigger players whose stocks we own hopefully will keep getting market shares.
Great. And, we spoke about themes and small cap and very core and very tight investment philosophy. But coming to the other, Bandhan fund schemes, particularly I'll talk about Flexi, BAF and large cap, right, which has not been performing as great as some of the other ones. What is your view there, and what's the investment thesis behind? Because that's still sitting on a lot of financial, like more large cap heavy, despite having that flexible sort of opportunity that you can take. What's your view there? Because they are usually the core sort of.
So the good part is we're seeing some green shoots. So in 1 year they've improved, but you're correct that obviously when you see 3-5 year performance, it's not as great as, let's say, small cap or large and mid cap. We're doing various things with each of them. So for example, with Flexi Cap, one of the things we've seen is that while the name is Flexi Cap, in true behavior, that category doesn't behave like Flexi Cap. Like if you go back to COVID bottom, it's not ideally, not very easy to do, but ideally you should have seen a lot of Flexi Cap go up to 50-70% in mid and small, right? But you don't see that happening. So we've done, just to control our human bias, we've linked it to a model which will tell us how much mid and small cap to have.
Okay.
And so what we're doing in Flexi Cap is we've tied our hands to a model so that we don't have human bias in terms of deciding the market cap. And this model will indicate to us, hopefully at the right time, to load up on mid and small caps. The last 1 year correction has meant that incrementally we've increased a bit of mid and small cap. So if you see 2024 calendar year, when mid and small caps did really well, we lagged a bit versus peers. But 2025, touchwood, has been a fairly good year.
Okay.
In terms of large cap, again, we've not done any surgery in terms of the structure like Flexi Cap, but I think the stock pings improved. So we've seen some improvement in performance. BAF, we're working on. Not everything out of 10 points will always do well, but hopefully it should be back on track.
Got it. So, Manish, I saw that you're overweight on certain sectors like financials and real estate, but I also saw that you're underweight on sectors primarily like IT, FMCG, and industrials. Why is that?
So let's start sector by sector, right? Industrials is where we actually think the risk of earnings downgrade is the highest, because private sector capex not picking up. Government, both state and central budgets have moved towards consumer stimulus rather than focusing too much on infra, which was the case from, let's say, 2020 to 2025. So clearly that to us is a bit of a simple underweight that we clearly think that earnings downgrade will happen. FMCG and IT, honestly, it's not that we're negative because these are generally high quality sectors, companies tend to be high ROE, but we just feel that the growth versus the valuations don't give us that doubling in 3 to 4 year feel, right?
Okay.
Some of them have not done anything for 3-4 years, particularly IT, some of these small caps, and they're tempting on a free cash flow yield basis. So a lot of them are at free cash flow yield of 4 to 5%. So as I said, we're not saying that they will fall too much from here, but we don't just get a feeling given that FMCG, the PE valuation is high. In IT, the thing is, we still think US will slow down. I know that's been what we call a widowmaker trade, that people have kept predicting and lost money. But we do think there is a risk of US slowing down. There is obviously a risk of AI disrupting coding too much. And given all that, while valuations are not expensive, we just don't get a feel that these stocks will give massive absolute return.
Got it. So IT, industrial, and FMCG, right? The three sectors. I understand on IT and industrial. FMCG is very interesting because usually it contradicts the whole India consumption story, right? So why the contradiction?
No, so we think there are better ways to play it through. Let's say financials, general insurance has exposure to motor and health, whatever, right? We generally find these indirect ways are more attractive. Because see, what happens with FMCG, because that sector did well from, let's say, 2010 to 2020. The P multiples went up to 40, 50, 60 times. And also, I think, unlike some other sectors, the penetration-driven growth is largely behind, we feel. So if you see India's demographics, right, while at a country level, we're still growing a bit in terms of people. But when you see it on a GDP weighted basis, that the more affluent states, the south and west states, we already had birth rates similar to Europe, right? So let's say for a soap and detergent, it's not that if my earning goes up 50%, I'll use more soaps and detergents, right? The story there is penetration, that from unorganized to organized or whatever. But we think that's more or less largely done with, right?
Yeah.
Because now we are in many states in the next 4-5 years, we are approaching peak population act. Places like Tamil Nadu or Maharashtra. Next 5 to 7 years, they will hit peak population. In which case, these very basic things will hit maximum penetration. Beyond that, it's just inflation growth, right? Not very attractive given the valuations.
No, totally makes sense. And I think one last question before we move outside the Bandhan small cap universe is, on the returns. And as an investor, I always have this question that as the AUM increases, right, it becomes difficult to, generate the same kind of returns, and particularly in small cap because of the liquidity issues and everything. What's your view on, this particular fund?
So this is something which I believed in 10, 12 years back.
Okay.
I don't know if it's necessarily true, because I've seen funds of 20,000, 50,000 crore. May not be top of the category, but they've done fairly well, even quartile one, top decile also. So I think there are two counteracting forces here. One is, as your fund scales up, you're correct that my ability to be nimble goes down. So, for example, if my small cap fund becomes 50,000 crores, then when I look at a 3,000 crore market cap company, how much can I buy that will move the needle for me? But I think there is a positive effect, which is that if your fund is big, then the research team that you can put behind it, because your company's revenues and your department or products revenues are higher. I think the quality of the team that you can put behind that product can counteract this loss of nimbleness, which I've seen actually work. Because clearly today, a large AMC, if you see the average level of experience of an analyst in a large AMC, they're materially higher than an AMC with 5,000 crore a year, correct? Because the large AMCs can afford to recruit a 20-year experienced analyst or a 10-year experienced analyst, which small AMCs can't do. So it's how that balance works. So I'm not necessarily now of the view that just because you're small, you'll do well.
What is that threshold?
I don't know. I was in Nippon earlier, and when that Nippon small cap fund kept scaling up, we thought others will catch up with us on performance. But for a long time, it didn't happen. Um, so, and maybe it's a bias. We felt our team was better.
And that's been sort of replaying here as well. So I think great. I think that sort of soothes me as an investor that I don't have to worry about it.
Yes.
And coming to the outside the small cap universe on your other schemes, right? Primarily, I'll talk about three schemes: large cap, flexi, and BAF. Right?
Yeah.
I think there's a lot of exposure to large cap in particular. What's your view there? Because they have not been able to perform as good as the
Yeah,
other.
so as I said, BAF and FlexiCam, we are on a model basis.
Okay.
So I'll just give you some color how this works, right? So when we do these models, a lot of the indicators we use are indicators which mean revert fairly rapidly. So we're not talking of indicators which mean revert in 10 years or 5 years. Typically, every year, some global accident, major, minor happens, and then you get a correction, right? So at India level, for example, the India-Pakistan war happened. But the bigger corrections are when global accidents happen. Like Silicon Valley happened about 1 or 2 years back, right? Now, we use these indicators like volatility, cross-asset volatility, which takes volatility of not only equities, but commodities, bonds, etc. Another parameter is credit spreads, right? Credit spreads, if you see, it's typical fear and greed that when they become too low, some accident happens, they go up, and then things settle down, it comes down, right? So the mean revert very rapidly. The funny part has been that over last 12 to 18 months, we've not seen any big global accident happen. So we're waiting for those mean reversions to happen to go more in small and mid caps in BAF and FlexiCap, because we think the model will work long term. And in a sense, FlexiCap has already benefited, because while small and mid caps have not corrected massively, if you see, one reason why FlexiCap has done well in 2025 is because we had higher large cap, which obviously is outperformed small and mid cap. So that has started to work. Hopefully, we continue on the same line for next 2-3 years. Maybe 2 years later, hopefully, we'll be sitting and discussing flexi cap like we do small cap today.
Sure. I would really look forward to that conversation.
Large cap, there's not too much of leeway, honestly, to tinker, because 80% has to be the top 100 stocks. So the only thing you work upon is your stock selection and stock weights, because obviously the universe being limited, more about stock weights. Everyone will have HDFC Bank, Infosys, all the large caps, but you try to work. And again, I think on 1 year, we've massively improved the performance. But it'll take time to show up in 3 to 5 years.
Is your core investment philosophy themes, like going after certain themes, like similar as you do in Small.
So one thing culturally we have, good or bad, but we think obviously is good, is we let every fund manager run with their own thought process, right? We don't believe that there should be a house call on style or currency or commodity or whatever. It's not that all of us believe rupee will depreciate or appreciate, that Fed will cut or not cut, RBI will cut or not cut. We let someone who's very value conscious way of investing, we let them work. They want to. We are more focused on measuring output on a 5-year basis. 3 to 5 year is the sweet spot. We don't micromanage analysts or fund managers.
Okay.
So one of the processes, or rather lack of process, is that we don't reward any analyst for the house buying what he or she recommended. We don't force the fund manager to buy only what the analyst likes. So both we see as very independent. And I think that works because over time what I have seen is that the ways you make money in this market are enormous. Everyone will have a certain way of thinking about things. Someone may use sell side well, someone may use channel checks well, someone may know how to read a management well. Not everyone will be good in everything, obviously, right? So you can't go and tell an analyst think like this, right? So we kind of let people be in that sense. So you will see that our portfolios are very different across funds. So the themes I talked about may not be there in some of the funds.
Interesting. On that note, what's your personal portfolio like, Manish? If you can tell us a little bit.
So I don't do stocks because of compliance reasons. I'm a hardcore believer in equities in the sense that I've not bought real estate since 2010.
Okay.
I have a bit of gold and silver because I'm also a believer right now. It's cyclical, but this whole debasement trade I believe in, that governments will print money. So all risk assets will keep going up, whether it's gold, silver, Indian equities, emerging equities, US tech. So I keep, the way I kind of manage my risk is moving from fully diversified funds to hybrid funds.
Okay.
So when I feel that the market seems very hot and overvalued, I would switch from a diversified fund to a hybrid fund. So apart from my PF money, I don't have any fixed income broadly.
Okay, interesting. Of course.
So no incremental real estate, no incremental fixed income, only equities, gold, silver.
Interesting. And for a retail investor out there who's also fairly aggressive, think about someone in their early 30s, right? Because you mentioned having commodities, gold, silver. What would you recommend, say, a percentage of portfolio that they should have?
It depends on this problem, but I think anywhere between 5 to 20% is a good hedge.
Okay.
See, they are obviously not, okay, you can't define them as cheap or expensive because earnings happening. But yes, typically you should be contrarian, but they've already done well.
Yeah.
But I still think as a hedge, you should have 5 to 20%.
Right, right. And on that note, because, we are talking about hedging and, the whole global situation, and I think probably I'll wrap up the conversation with this final question. I think I was hearing some of your interviews and you were mentioning about, how the global economy is so unstable compared to, what it was 10 years ago. Secondly, with the incoming of AI, I personally have a view that, how will India survive in terms of, AI taking away jobs and, unemployment may increase.
Yeah.
What's your view on India's growth story amidst all of that is happening in the world?
So, just like many things in life, there are positive things and negative things. See, if you think about it, India is a gold to oil story, gold to oil ratio story, right? We benefit when gold prices go up. We benefit when oil prices go down because we own a lot of gold.
Right.
We have about $3 trillion of gold, muta muti. And then we have our biggest import is energy oil.
Yeah.
Right? So if you see from that perspective, the last 10 years have been a boon,
Hmm.
right? If you go back 10 years, oil was a 120, now it's 60.
Yes.
Gold was whatever it was, obviously has quadrupled, doubled, whatever. So if you see the household balance sheet, it's improved a lot because of gold over the last 3 years, right? In fact, India is one of the few countries where bank deposits are almost 1/3 of gold holding.
Yeah.
Right? I mean,
We love
no
gold.
modern country like this.
Yeah.
So that is the positive side. The negative side, as you said, is AI, where we just have to be open. See, I don't think you can have a very decisive view of whether India will get hurt very badly, to the other extreme that some people also claim India will benefit, because just like with cloud and Y2K, there will be need to implement solutions around AI that actually benefited India in cloud and Y2K and all that, right? But yes, this is a very peculiar technology because it's very horizontal.
Yeah.
It obviously disrupts human labor, and we are big exporters of human labor, either through service exports or through remittances,
Correct.
right? So we have to be very conscious of the risk there. I think it's a tail risk, that the net job creation of AI, because initially it will reduce jobs, and generally with technology, it creates jobs slightly longer term. The challenge is, of course, it may not create the job for the same person. Like when coal miners were replaced by automation, the coal miner did not go and do coding, right? So that's the sad part. But we have to be open about how much impact there will be. But it is a risk for India, yes.
Great. I think so. Net, I think looks like a positive outlook for India's growth story, and I think that's what we are believing in. And thank you so much, Manish, for sharing all these insights. It was such a lovely and insightful conversation. I, as an investor, am much more confident on how I feel about Bandhan schemes. And thank you so much for taking out the time.
Thanks, and I'm very happy you are reassured about Bandhan Small.
I hope the audience will be too.
Thank you.
Thanks.